Good day, all. I want to welcome you once again to my YouTube channel. Thank you very much for joining. We're continuing with where we stopped last time. We're talking about cash book and bank reconciliation. Once again, by this time around, we're looking at the other leg of it that talks about bank reconciliation. Remember, in the last class, we talked about cash book and the different types of it. And of course, we did one or two examples just to help us to know how to, uh, balance accounts and of course post entries into our different cash books that we have. So this time around, we are looking at bank reconciliation. So please join me even as we continue at this particular point in time. Let me just share my screen so that we can all be part of the class once again. Just a moment, talking about bank reconciliation. So let me just open it up much more. So bank reconciliation. My name is Dr. Bafemi. Once again, you're welcome once again. So let's start. What are the learning objectives at this particular time? Now, at the end of this presentation, it's expected that students will understand the meaning and concept of bank reconciliation. And not only that, they will be able to also differentiate between bank reconciliation and bank reconciliation statement. And again, we also be able to know the objectives of bank reconciliation. That is to say, why do we have to carry out bank reconciliation? Understand the reasons why there are differences between bank statement and then cash book balances, and how do we, how to prepare bank reconciliation statement at the end of the day. That's at the end of every month, as the case may be, or maybe a daily or weekly or monthly basis. Okay, so let's just continue as we look at the concept of bank reconciliation. What is bank reconciliation? The bank reconciliation is a process. You have to appreciate this, going forward. Bank reconciliation is a process that explains the difference between the bank balance shown in the bank statement of an entity as supplied by the bank and cash book balance shown in the entity's books at any particular point in time. What does that tell us from this particular moment? Number one, a bank will maintain a cash book or maintain records of all the transactions between the entity and the institution. And at the same time, the organization too is also maintaining this, transactions between, maintaining records of transactions between itself and the bank. Okay, so at the end of the day, when the bank statement is taken or received from the bank, okay, there is the need to compare the different balances, because as soon as the bank is recording its own transactions, so at the same time this organization is also recording its own transactions. At the end of the day, they might arrive at two different balances at the end of the day. So there is a need for reconciliation to be done when that takes place. So bank reconciliation is a process that explains the difference between the bank balance shown in the bank statement of an entity as supplied by the bank. Bank statement is usually given by the bank, and then the cash book balance as shown in the books entity at any given point in time. Okay, so let's look at bank reconciliation statement. So when we now talk about bank reconciliation, what are we really talking about? Now I put it there: bank reconciliation versus bank reconciliation statement. No, there are two different things. One is the process, one is the outcome. One is the process. Bank reconciliation is the process, and then bank reconciliation statement is the outcome. All right, so bank reconciliation statement is a detailed statement written to show the factors responsible for the difference between the bank balances and cash book balance as at a given date and its reconciliation. So bank reconciliation will show the detail, the detail of all the factors relating to why we have differences, and then it will now show the reconciliation itself. Okay, practically it shows the name of the identity, the name of the entity, the name of the bank when reconciled, and the month or date to which the reconciliation relates, and the reconciliation itself. So that talks about bank reconciliation statement. Let's look at the concept. Now, I've explained this before. Usually, the bank maintains records of all transactions that is bank receipts and payment between between the company and the bank. At the end of the month, a summary of these transactions are provided in form of the statement. Starting with the opening balance, all the lodgements of the bank are shown in the credit column. That's when you have your bank statement. All the lodgements are shown in the credit column of the statement, while all payments are shown in the debit column of of the balance statement. At the end of this, will reveal a balance at the end of the period. Okay, so in most cases, however, the closing balance of the bank statement is usually different from that of the cash book in most cases. All right. So the thing here is the moment you get your bank statement from the bank, okay, you compare all the transactions entered into the bank statement. The credit side or the credit column we compare with the debit side of the cash book that you have. Remember, we did cash book, in the last class. All right. So on the debit side, you have your receipt. Meanwhile, in the bank statement, you have it in the debit, in the credit column. It's going to be there in the credit column because it's a liability. The company, I mean, the bank has to pay you because the bank is now owing you, as it were. So it's a liability on the part of the bank. So the bank is taking it as a credit. So that's why it's being recorded in the credit column. All right. So you compare the credit, all the transactions in the credit column, compare with the debit side of your own cash book. And then at the end of the day, you compare the different, the balances. So where there are differences, you now need to look at them, look at the the difference between the bank statement balance and then that's the cash flow balance, and then you carry out a reconciliation. All right. So what are the objectives of bank reconciliation? Number one is to identify the difference between the entity's bank statement balance and balance carried in the company's books with a view to resolving the discrepancies between the two records. So the first is to identify the difference. Number two, bank reconciliation is carried out to check the correctness of both the bank and entities records. So it is important to check whether they have been correctly recorded, both on the part of the institution, that's the bank, and then on the part of the company itself, because it's possible for errors to have been made. Okay. Number three, bank reconciliation will enable organizations to ensure the authenticity of the company's bank balance or balances reflected in the financial statement. Now, at the end of the day, when you are preparing your statement of financial position, you have your current assets, okay, current asset. So when you prepare your bank reconciliation, it will help the organization to verify or to ensure, that indeed it is the actual figure that is retained or that is maintained or kept in or transferred, or rather, I mean, you want to say extracted from a trial balance, and that's what you have in your that's what you have in your system of financial position. And then bank reconciliation statements are often required by the company's auditors as well. So when they come to carry out an audit, they check to find out whether you have been able to maintain your internal control over your bank balance or balances, as it were, if you have more than one bank account. So they want to ensure that you have done that. So one of the ways by which you have been able to ascertain or identify or done, you want to show to them that you have been able to actually capture your bank balance is for you to present your bank reconciliation statement. All right. So, and then finally, bank reconciliation helps in detecting data entry errors early and resolving them on time, thereby enhancing the accuracy of the records. All right. So, why do we have differences, or why do we have a difference between the bank and then the cash book balances? Why do we have a difference? Number one, there are three major reasons. Okay. Number one, let's look at the first one. Transactions recorded in the cash book of business but not in the bank statement. So we're saying here it's possible for some transactions to have been recorded in the cash book, but these same transactions are not being reflected, okay, in the bank statement. And examples are unpresented checks and then uncredited checks. Unpresented checks are checks raised by the company, but are yet to be presented, maybe by the person that the share has been given to. Okay, that's unpresented as at the period of preparing the bank reconciliation statement. So that particular check has not been presented. Remember, the lifetime of any check, is 6 months in Nigeria. Is 6 months. Okay, the lifetime of the check is 6 months. And what does that mean? It means that it's possible for somebody to hold your check for the next 6 months and still be valid. All right, still be valid for presentation at any particular point in time. It's only when it's after or beyond 6 months that it becomes stale. All right, so uncredited checks as well. So it's possible for you to have, lodged in some checks, but you are not received value for it. There's always a time lag between the date of deposit and then when the credit is given. So it's possible for this to happen. So on the part of the bank, you have done your own bit, but of course, the bank is yet to be reflected in the bank statement. Number two, transactions recorded in the bank statement, but not in the cash book. So it's also possible for some transactions to be recorded in the bank statement, okay, known to the bankers, known to the not to your bankers, okay, but not known to you. So it's possible for such things to have taken place. For example, we talk about bank charges. All right, we talk about loan interest. Peradventure, you're taking a loan from the bank. Direct deposit, maybe somebody created your account without letting you know, there and then, okay, as at the end of the period, or payments. So it's also possible for you to have, direct payment. For example, you're giving a standing order to make some payment on your behalf, but as giving a standing order to the bank, make some payments on my behalf every month. So it's possible for these payments to be made and for you not to have been notified. So the third reason is errors made in the cash book and in the bank statement. Okay, errors made in the cash book or in the bank statement. So it's possible for some omissions to have been made, posting errors to have been made, okay, either by the bank or even by ourselves. So we have errors, okay, that your checking or your reconciliation will reveal. And that is why these are the reasons why we have, a difference between the bank statement balance and the cash book balance. Okay, three major reasons. And so how do we carry out bank reconciliation? Number one, ascertain the balance as per cash book and balance as per bank. That's the first thing you have to do. Ascertain the balance. Number two, adjust the cash book balance with transactions in the bank statement but not recorded in the cash book, such as bank charges, direct lodgements, and direct payments and return checks. So you need to check all these things and then make sure that you adjust your cash book balance. All right. Trace the cash receipt to the bank statement to ascertain whether some deposits are yet to be acknowledged by the bank. I've said that before. You trace your cash receipt in the bank statement, that's the one in the credit column, okay? And then check with your own deposits to see whether there are some deposits that are yet to be acknowledged, okay, in the bank or created by the bank. Then number four, trace the checks issued to the bank, okay? Check, just let me go back. Let me go back. Let me go back. Let me go back. Okay, number four, trace the checks issued to the bank, okay, to ascertain whether there are checks not yet presented for payment. This is not to the bank statement. Shouldn't be to the bank statement, but rather it's to the bank. Okay, let me just correct that to the bank, and then let me also correct it. Okay, to the bank. So it is important that you take note of this factor. Trace the checks issued to the bank to ascertain whether there are checks not yet presented for payment. So this will help you to detect unpresented checks. Okay, then prepare your bank reconciliation statement at the end of the day. After having done all of this, then you can now go ahead to prepare your bank reconciliation. Let's look at the format. Okay, for example, SYZ, Oligo Bank, PLC, that's the bank, the name of the company, and then the name of the bank concession statement as at. There must be a given date. Okay, I must have a label, I will have a title like this when you're preparing your bank concession statement practically. Bank balance as per bank statement, that is usually we use the bank because it is presumed that of the bank statement is correct. is always right. It is presumed, but of course, we know that it's not always correct. So it is presumed. That's why I use the word presumed. Okay, so balance as per bank statement, add uncredited lodgements, less unpresented checks. Okay, and the reason is for doing that is to say, okay, once if uncredited lodgements had been, added or had been credited, then the balance would have increased. So that's why you are adding uncredited lodgements to it. Okay, and the same vein, if, or on the other hand, if your payments, the checks raised have been presented, it would have reduced your bank statement balance. So you are going to, that's why we're deducting, the unpresented payments. Okay, unpresented checks. Now you're going to add or deduct, as soon as you add or deduct errors made by the bank. So it's possible for banks to make errors. So you deduct it. Now, if there are errors made by you as the accountant or as the entity, you need to correct it in your own adjusted cash book, account. So you need to correct it yourself. Errors made by you must be corrected by the accountant or by the organization. But errors made by the bank cannot be corrected, just like that on the face value. The bank must be the one to correct their own errors. So what do you have to do? You have to write to the bank to say we have observed or we have detected some errors. Please correct this. Okay, so that you're able to align with your own, bank balance at the end of the day. So that is how to present, or that is the way to do it. So this is supposed to read balance as per, since we started with balance as per bank statement, so this should read balance as per cash book, balance as per cash book, and not pardon me, cash book. Okay, that's what you should have. Balance as per cash book. In most cases, adjusted cash book, because it's expected that you would have adjusted your cash book to reflect some transactions that hitherto the bank recognized, but you didn't recognize initially. So that's why you have that there. Okay, so let's go on to this example. This example we're going to just do now, and then just to we're going to work it out so that we're able to know how to actually reconcile, bank um, bank statements. Okay, reconcile your balances. So we said the cash book of ROI Limited had a debit balance of 760 as at this date. Okay, but this information is different from what you have in your bank statement. All right, an investigation into the difference yield the following information. So these are the reasons given. Okay, your reserve or the company has observed. So now you will now need to update the cash book and then drop the bank consolidation statement as at June 30th, 2024. So, and then how will the company resolve the error made by the bank? Now, there's one particular entry here talking about the errors made by the bank. Check of 504 naira lodged in by ROY, who maintained an account with the same bank, was credited wrongly by the bank to the account of ROI. So instead of posting this transaction to ROY, they posted it to ROI. So you know that this money, does not belong to ROI. Okay, it belongs to ROY, but incidentally or wrongfully they posted it to ROI. So in such an instance, you need to write to the bank to correct their own error. You can't do it on the face value. You can't do it in your reconciliation. But all you have to do is just bring it up and reflect it there so that it is clear. And until it is resolved, you keep on carrying that same figure, from one month to another month to another month. Okay, so let's just look at how to do this. So the first thing to do is to update your cash book balance. Okay, to update your cash book of ROI Limited. So let's go and see how that is to be done. So we have ROI Limited, adjusted cash book. Okay, this is the debit side and this is the credit side. So here, all we have to do first and foremost is to look at what we have. What do we have now? So the date, usually now we're talking about 30 30th of June, as it were, 30 June. Okay, that's what we have. Balance brought forward. Balance brought forward is what we have. What's the amount? If we go back to our question, 760. 760. So let's go over to the amount. I will record 760 there. Okay, 760. Now let's go to the next line. Okay, a check for utilities on June 2, 2024 for 358 had been entered in the cash book as 385. So instead of recording this transaction as 358, the organization, that's the entity now, has recorded as 385. So that means that they increased, look at the difference. This one is higher. Okay, they increased the figure by how much now? 5885, that's 7, 25, 27 naira. 27 naira. Can you see now? There's a difference of 27 naira. So the amount recorded has been overstated by 27 naira. So what do? You have to now come back to your cash book and make an adjustment. Okay, now the date was not given, so we may not be bothered with the date, in this type of question. Okay, so come here to say posting error. Because it was overstated, now you have to restore it and bring it back to the original position. Now, cash, you can't just say, I want to go back and cancel it. This is what you have to do. That's why I call it adjusted. Okay, so here you talk about utilities. Okay, utilities. So how much? 27 naira. 27 naira. That is what you have. Okay, let's go back to the next one. A standing order for a charitable subscription of 80 had been paid by the bank on June 29, but no entry had been made in the cash book. Now, so I haven't received the bank statement. You observe that they actually made 80 naira subscription, okay, to an organization. A standing order of 80 naira had been made. So what do? You come back to your adjusted cash book, and then you record the amount there, and what we call it a standing order. Standing order, that's 80 naira. Let me just use the beginning, 80 naira. Okay, so you're done with that as well. So you move on. Let's see the next transaction. The next transaction, checks received from customers amounting to 3360 were unpaid in the bank, were paid into the bank on June 30th, but this was not reflected in bank statement. Of course, expectedly, there's always a time lag, like I said. Okay, expectedly today in Nigeria, we talk about T+1, so it must be the date of deposit plus another day before you can get a credit. All right, so you come back to your this time around now. This will not be affect your cash book. You posted it correctly, so it is the bank that is yet to give you credit. So this is called uncredited lodgement. These are uncredited, lodgement, because checks received from customers amount to this were paid to the bank. So the bank is one, that hasn't credited you. So let's move on. So please take note of that, because it's going to be part of your reconciling items. On June 20th, 2024, a check for 228 was received from a customer in settlement of an invoice of 240. An entry of 240 was made in the cash book. Okay, the cash book. So now let's look at this particular story. 240 was the amount. Okay, but then 228 was received. But instead of posting 228, he posted 240. What does that mean? It means that you have overstated the amount of money received. So you have debited your account with 240 instead of 228. So what do? You have to find the difference, look for the difference, and then add it to your credit. Okay, what am I credit? You must now credit your cash. to remove the difference from the initial 240 that you posted. So what's the difference here is 12. So let's go to our account here, our adjusted cash. So you have, posting error as well, posting error, and then this time around, receipt from customers. Receipt from customer. How much? 12. 12. So let's go. That done, you go back to our question. Then checks of 2034 sent to payables on 30th, 2024 were not paid by the bank until July 6, 2024. What does that mean? These checks were not presented until July 6, 2024. So this will stand as unpresented checks. This will stand as unpresented checks. So this will not be part of your um, adjustment, but rather to part of your reconciling items. So let's go to the next one. The check of 504, we have spoken about this before. Okay, lodging by Raw, okay, Limited, who maintain an account with the same bank, was created wrongly by the bank to the account of ROI. So ROY, okay, the instrument belong to ROY was actually lodged or created to the account of ROI. Okay, when you see such an instance, please don't spend it. Okay, if it happens to you, because the owner of the money will come for you, at the end of the day. All right. Okay, so let's move on. Now we have been able to look at these two entries here and then two entries on this side. So let's try to strike a balance. I hope we are not leaving out anything. 1, 2, 3, 4, 5, 6. This is the balance at the end of the day. 6. And we have treated 4 elements or 3, leaving out 2, which is understandable. So 2 for unpresented, 2 for this one, and then 1 again for the one that's the error from. So I think we're in order. So let's go ahead and look at the balance, if there is any. So what do we have? I think we have a balance. Balance, this is the adjusted balance now, not the old one. This is the adjusted balance. So what do we have? Let's look at the difference. This is 92. What is the total in the first instance? This here we have 787, correct? So here again, we also have what you should also have would be 787. So what's the difference between the two? 80, 92. So you bring out your calculator to confirm my own posting as well. I believe you are there, and I believe you are listening to what we're saying. So the difference is 695, 695. Okay, 695 is what we have as our new balance. So what you're going to have here is balance carried out. So that will stand as our adjusted, balance. Okay, so here I'll just underline it, and then here I'll also underline it. Okay, so that's what we have. This is our new balance. Okay, that you'll be working with. You're no longer going to be working with 760. You're now going to be working with that. This adjusted cash book balance. So let's go to our bank reconciliation now. Okay, the name of the company is ROI Limited. Okay, and what are we doing? Bank reconciliation. Bank reconciliation statement. Okay, as at June 30, 2024. Now, the name of the bank was not given, so we cannot just go ahead and assume it. So if practically you see the name of the bank, I have to write the name of the bank. Okay, that's right, the name of the bank. So let's go and look at what we have to do. Okay, balance as per bank statement. Bank statement. How much do we have? Let's go to our question. Balance as per bank statement overdrawn by it's 87. 87. So let's come here and put 87 there. If you remember, it must be in negative. Okay. So look at our what you say we should do. Don't forget this. Okay. You're now going to add uncredited lodgement. Uncredited, add uncredited lodgement. Uncredited lodgement. How much? Now, uncredited lodgements, we have identified that before. Okay. Check received by customers, but this was not paid to the bank, 3360. So we're going to add 3360, here. 3360, 3360, 3,660. So that's what we have. So let me put this appropriately. So that's what we have. So let's now deduct, or let me use what less. Less unpresented checks. How much? We have unpresented checks given as well. Unpresented checks of 2,074 sent to payables on this date, but that's yet to be reflected as at the end of the month of June 2074. So we have 2074. That's what we have. So let me also now align this properly. Okay, yeah. So that's what we have. Now, don't forget that let me put the, okay. So that's what we have there. Now let's look at the next item. We talk about errors. Okay, we talk about errors. So let's look at this check of this amount. Login, we have identified that earlier on. So let's come to this account now. I use the word less or add. So errors could be positive. The treatment could be positive, could also be negative. Okay, bank error. So you have to, for you to know how to treat, whether it's going to deduct or whether you're going to add, you have to look at the effect. What happened in this case? All right. The bank, inadvertently posted and created your account of the company of ROI. And so that means that this amount must have been inflated. Okay, must have been inflated. And that's why you have it like this figure. Now that it's affected, it's coming down to this figure is what this means, that this amount would have been probably more than this if that error had not been made. That would have been more than this. So what would you do? You are now going to remove the 504. That's the figure. 504 from the amount. That's what you're going to do. That's the effect. So you have to understand the effect. That will enable you to know whether you're going to add or you're going to deduct. Okay, so we have been able to arrive at this now. So there's no other thing to do. So let's find out and let's see. What do we have? Balance as per. We can go ahead to check now. Adjusted cash book. Adjusted cash book. So let's see what we have here. Whether we are on course, because it should actually tally with whatever it is that we did to get. So let's go and check. 87 minus okay, plus 3360, okay, minus 2074, then minus 504. So what do we have? 695. 69500. So you can see that our 695 is the same thing as the adjusted figure of 695. So in that case, it means that we have been able to reconcile and we're able to agree, okay, the two balances. We are able to reconcile the two balances to say, okay, this is the figure that we now have, the new figure in our adjusted cash book balance. Okay, so what do we have here? And that will bring us to the end of that particular question. Reconciling your cash book balance and then your bank statement balance at the end of the day. You can see that the figure, the figures are the same. The one here is also the same thing as the figure that we have in our adjusted cash book balance. I mean, adjusted cash book. So that means that we have been able to sort out the differences or recognize all the factors responsible, and we have been able to resolve it. So the reason why you have a particular figure and why the bank also has a different figure. So what must you do? Like I said earlier on, the next question that we're asked to provide, how would the company resolve the error made by the bank? So the company will now have to write an official letter intimating the bank that they made a mistake on a particular day by crediting an instrument that does not belong, to them into their bank account. The bank should now reverse it. So when they reverse it, then this one will be eliminated. There will be no more bank error. But until it is reversed, this figure, you keep on carrying it month in, month out. So I want to believe that you have been able to learn, again, you have been able to understand bank reconciliation. It's as simple as that. Bank reconciliation is not difficult. It's very, very simple. All it takes is just for you to understand some basic, factors and how they affect the balances. Once you understand that, then definitely you are all good to go, in resolving bank reconciliation, resolving bank account differences, as it were. So thank you for being part of the class once again, because we have come to the end of this class. Thank you for being part of it once again. So if you have learned one or two things, this one has imparted you, giving you, increase your knowledge, please, I endeavor to, like, and then endeavor to subscribe to my YouTube channel, because I believe that we still have a long way to once in a while we'll come up with some topics and then we'll post it here so that you can also be part of it. Basically, these are accounting related courses, accounting related issues, and then they are also there. If you subscribe, you see other posts that are other videos that are posted in the past, and they'll be able to as much as possible, just go there and check and gain more knowledge, gain more understanding, as much as possible. So thank you for joining once again. Don't forget, like, share, and subscribe to this. So make comments and then ask questions. And when I come online, I'll be able to just endeavor to answer or to make comments as well. That's trying to resolve whatever issues that you probably have. Thank you for joining once again. Thank you for being part of the class. God bless you. See you until that time. Bye for now.